Hi, I'm Jacob Watts, a certified financial planner professional with Legacy Financial Strategies. Today, I wanted to share a few key concepts of a valuable but underutilized tax strategy called Net Unrealized Appreciation, or NUA. NUA is a special tax rule that can apply to employer stock held inside a qualified retirement plan, like a 401k or ESOP. Normally, when money is withdrawn from a retirement account, it's taxed as ordinary income. That includes employer stock, but NUA allows part of that distribution to potentially be taxed at preferential long-term capital gains rates instead. Here's how it works. Shares of employer stock inside your retirement plan have what is called a cost basis, which is the price they were originally purchased for. Any growth above that amount is called the net unrealized appreciation. When utilizing an NUA distribution from your retirement plan, the shares of stock are not sold. They are instead transferred directly to a brokerage account, and upon doing so, the cost basis of the stock is taxed as ordinary income right away. However, the NUA portion, or the gain, is not taxed immediately. That gain is only taxed when you eventually sell the stock, and it's taxed at long-term capital gains rates instead, regardless of how long you personally hold the shares after the NUA distribution. Now, to qualify for NUA treatment, a few strict rules must be met. First, your entire retirement account must be distributed in the same tax year. Other holdings besides your NUA stock can be rolled over into an IRA and held separately from the stock you've moved into the brokerage account, but it must all move in the same tax year. Most retirement plans allow for distributions after reaching a certain age or retiring, but you'll certainly want to check with your plan-specific documents. Only publicly traded stock can typically be eligible for this treatment. So if your company stock cannot be held in a brokerage account, you'll likely need to sell it and roll cash over to your IRA. Regarding to the NUA strategy, NUA can be especially valuable for long-term tenured employees with heavily appreciated company stock. That said, it's not for everyone. You'll need to consider cash flow, tax liability, and concentration risk. And once you elect the NUA, it cannot be undone. To summarize, net unrealized appreciation can create meaningful tax savings, but it needs to be carefully modeled and coordinated with your broader tax and investment strategy before taking action. We strongly suggest speaking with a CPA and a certified financial planner professional. I'm Jacob Watts. Thanks for joining me, and we'll see you next time.